right into the slides, wherever they may be. Here, can you see that? So it has been a wild ride for the last year, and it's not over yet because while thankfully we moved from a really intense period of falling sales a year ago, we're now in this really intense period of realigning with what we missed out on and where we think things are going, and it's creating a number of dislocations throughout the economy, including real estate. I think those will tend to settle down over time, but it's a work in progress to be sure, and we haven't really been through something quite this dramatic in terms of the wideness of the swing to one side versus the other. So I'm going to stay really focused today on your board's data set. There's a lot that can be pulled from the patterns we're seeing, and we have gone through something really unprecedented, at least in the last 20 or 30 years. We're all familiar with the cycles in housing. We had one in the early 2000s, which was rooted in mortgage lending that had gotten a little out of hand. And it's interesting to hear Round Point Mortgage talk about, do you remember 20 years ago, anybody telling you about their criteria for making loans or their process? So we've regulated the industry more intensively. The players in mortgage lending today are all relatively high quality players. But we did have, as I say, a housing bubble, a cycle of large amplitude, both in prices and in volumes, sales volumes, and in production, associated with a period of excess beginning about 20 years ago, coming out of the 9/11 moment. And those of you who've been around longer know that we had a bubble associated with foreign investment 30 years ago, 40 years ago, and there have been other cycles in the past. So let's get into the data and try to answer the question of whether this is another bubble. I don't think so, but time will tell. So just looking in your board's data, we see a couple patterns worth digging into. Single-family home prices, as you guys follow the market, you know that they've exploded, whereas median condo prices have more or less stayed on the track they were on pre-COVID. And so we should spend some time thinking about why those paths are different and whether they'll continue to be different. Excuse me. While sales did drop about a year ago, as you know, for 2 or 3 months, they rebounded pretty quickly. I mean, kind of surprisingly, if you remember where our heads were at back in June of last year. But they didn't come back in the two market segments, single family and condos, in equivalent magnitude. So we'll take a look at that. And finally, you have to remember things were going on before COVID that were going to affect the market. And the one that we'll want to pay a little attention to for Metro Region is the City Council's initiative to enhance enforcement back in 2019 of a 30-year-old prohibition of what I call undocumented vacation rentals, which of course had proliferated in the subsequent 30 years. And something like 12,000 out of the 13,000 vacation rental units that were enumerated at that time statewide comprised condominiums. And that was definitely true, even though people talk about, Windward Oahu and North Shore and the proliferation of vacation rentals among beachfront homes, for example. The vast majority of vacation rentals were actually condominiums in Waikiki and elsewhere in the metro area. So let's try to put all these things together and explain what we see now in these two really disparate data set performances. Single-family home prices are knocking on the door of $1 million, or as Dr. Evil says, $1 million. And we'll be there this summer, probably this month, and then you'll see the headline, and everybody's heads will explode. $1 million, what are we going to do? And, everybody's going to be screaming about housing affordability, blah, 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 schmackety schmack. So I'm just telling you, it's going to happen. It was going to happen anyway. You can see that the trend in the trend in Honolulu for single-family home prices was for the 20 teens. This is a regression from 2012 to 2018. But you can see that the path was consistent with 4% annual appreciation, which seems like a reasonable, if the inflation rate's 2%, then home prices rise 2% more than inflation. And so, I'll invest in a house and get my 4%. And plus I get to live in the house, which I can't do in a treasury bond. So that's the, world we knew before COVID, and the world to which, reasonably you could expect we'd have returned in the event of any kind of recession, not just the recession of the particular character that we experienced, and I think briefly at this time last year. But there you go. Notice that before the COVID recession, single-family home prices had actually flattened out for a year and a half. So when we had this meeting a couple of years ago, we were talking about prices sort of drifting off below trend and what that represented, because it wasn't just in home prices that we saw this stagnation, but we were seeing it in the economy as a whole. And Hawaii's economy essentially stopped growing about the middle of 2018. Nobody was talking about it. I mean, tourism actually declined in 2019, pre-COVID. And nobody was even talking about that. I'm going, you guys, tourism just went down. That is the constant dollar value of tourism receipts. Now, contrast the explosion in single-family home prices in this sort of post-COVID interval since about, the middle of last summer with the path of condominium prices. And this is why it's so important in Metro region, because the market in Honolulu's urban core is dominated by residential condominiums. In contrast to single-family home prices, condo valuations, that is median condominium prices, haven't quite returned to the pre-COVID trend of about 5% appreciation. Condos are the more affordable segment in general. And so in a low interest rate environment, such as we've enjoyed for much of the decade, they were experiencing a little more robust appreciation. So thinking about this dichotomy, single family home prices exploding above trend, exploding out of bounds of the trend of the last decade to knock on the door of $1 million, while condos continue to grind up the escalator slowly at let's call it 460,000 on a seasonally adjusted basis. I've seasonally adjusted your board's data. This one slide pretty much tells you everything we're going to talk about for the rest of the half hour here. We were looking at median prices, existing home sales prices, both for single family homes and condominiums. These are the sales volumes adjusted for seasonality. And yes, there are more condo sales than single family home sales. It's the more affordable segment. People can engage and investors can participate more readily with the lower threshold, lower down payments, et cetera, a better ability to qualify. And there's the cycle, the Japan bubble back in the late 1980s, the subprime bubble in the early 2000s, and then a much more attenuated rise in sales volumes pre-COVID in the 20-teens, punctuated by COVID, but only very sharply, as I say, 1 year ago for, one quarter before a really solid rebound. And in the case of condos, a rebound right back to what you see there as the pre-COVID trend, which had stagnated in 2019. Now in 2019, we were going through this weird moment where the city suddenly decided after 30 years to enforce the vacation rental ban in the summer of 2019. So the ordinance passed in June of 2019 and was implemented as of August 1st. So small investors who had, put all their eggs in the vacation rental basket suddenly found themselves scurrying to unload those investments. And what you see if you look at the ratio of listings to sales, so think of new homes available for sale divided by the actual flow, sales volumes, the listings were piling up in the condo segment pre-COVID. And even though the Federal Reserve was moving towards renewing lower interest rates, the Fed had normalized interest rates somewhat in late in 2017 and 2018, and you recall that interest rate normalization, slightly higher mortgage interest, still low, but slightly higher mortgage interest rates in 2018, led inventories to pile up a little, right? Sales weren't growing as fast as listings, so the ratio was going up in 2018. And then as the Fed reversed course and began to lower interest rates, the ratio of listings to sales in the single-family segment was declining pre-COVID, but it got hung up on the condo side. And then, of course, when COVID came, the vacation rentals stopped entirely because tourism stopped. And so people were bailing from that segment. On the other hand, because of remote work, in part, the demand for single-family homes actually increased during the COVID moment. And so you have this weird dichotomy of movements. Listings on the single-family side during COVID dropped more than condo listings did, whereas sales on the condo side dropped more than sales on the single-family side. That's all that this image is telling you. Let me say that again. Listings dropped more for single-family homes than for condos during the COVID moment, but sales dropped more for condos than for single-family homes during the COVID moment. And as a consequence, you had this kind of train wreck where months of inventory, which ordinarily for both condo and condominiums and for single-family homes, move hand in hand. This is the pattern, for this century to date. For 20 years, months of inventory remaining for condos and single-family homes moved hand in hand. When they went up together. When they went down together, until the city introduced this enhanced enforcement of the vacation rental ban, and then the double whammy, the COVID moment arrived. And let's close up on that period. If you do the math, months of inventory remaining for condos and single-family homes were highly correlated pre-COVID. The correlation was 0.97, and 1 is the maximum. The range is 1 to -1. Condo and single-family home months of inventory remaining were correlated 0.97, 97% of the time, whereas for a few months after COVID, they reversed and moved in opposite directions for the first time ever with a correlation of -0.6. So there's that close-up of months of inventory remaining, a pile up on the condo side as absorption was unusually strong on the single-family side. But now, of course, things are moving back into realignment. And these are the monthly data through last month. So these are the most current data we have. You can see the condos are catching up quite quickly. So that moment is over. But it happened, that happened. And it is really a profound reflection of how unusual the market was, however briefly, as I say, about a year ago. The next thing we'll look at to try to ferret out what's going on, this is a technical thing. I'm going to go through this really fast. But let's just look at price movements and then extract the long-term trend, that 4% or 5% trend that we were looking at earlier. And then we'll calculate the difference between the prices and the trend to get a measure we'll call detrended prices. And from that detrended price series, the prices without the trend, we'll also extract a cycle. And that will leave us with sort of a residual piece that's going to be interesting to look at. So let's just do this really fast, no math anxiety. Here are median single-family home prices back to 1980. Okay, so there's the escalator, the long-term appreciation, around which the roller coaster of the valuation cycle is exhibited. So that the roller coaster is the actual cycle, but in the end, you get back to the escalator you were on all along. And if this is a bubble right now with single-family home prices punching out to 1 million, if this is yet another bubble, as the bubbles we've seen before, it's probably going to end up going back to the escalator, to the trend. I'm just saying, I'm sorry, but that's what bubbles do. They burst, right? Did you buy GameStop? There you go. Are you investing in AMC? Own a lot of Bitcoin, do you? Well, that's what bubbles are. So we're going to take that trend and extract it from the actual roller coaster of home prices to get detrended prices, the shaded areas of recessions. So now the cycle comes into really strong relief for single-family homes, and we'll take out the cycle, and what we're left with is a residual non-cyclical component. And I'll just draw your attention to the zounds at the right side of the screen. That's that last jump. It's like an $80,000 reversal in the non-cyclical component of median single-family home prices. That's a huge change. So, okay, we've just validated what we already knew. Something wacky is going on the single-family side of the model, and here it is in close-up. Zounds, from minus 40 to plus 40,000 and an $80,000 in absolute value reversal in the non-cyclical residual component of Oahu single-family home prices. Okay, the thing going up, zounds, that's your takeaway. Forget about the math. Now let's do it for condos. Same thing, you've got the roller coaster around the escalator. The slope is about 4 or 5%, just as it is for single-family homes. And why would it not be? We'll detrend the condo prices, and that's what you get. Then we'll remove the cycle, and oh, wait, there's no zounds. There's only a meh. So yes, we've just validated what we already knew. Single-family home prices on Oahu right now are doing something that condo prices are not. And so we'll just have to, work our way through it, just so we understand that looking at the overall numbers for the island is only one way of looking at it. The other is to drill down to the neighborhoods. There definitely is something going on that we haven't seen. These are single-family home price appreciation rates, 5%, 10% for the year, for 2020, for last year. Now, we can look at the first 5 months of this year, but the problem, you start to get into this weird comparison. Last year at this time, people were hiding out in their caves, hibernating in their caves, their COVID caves. And so I'm inclined to just stick with annual comparisons. Here we'll look at 2020 versus 2019, because that takes out all the seasonality and sort of the problem with looking at year over year numbers in general is that maybe something wacky happened last year rather than this year. At any rate, the pattern by now you see and are probably already familiar with looking at these appreciation rates for single-family homes is that, the leading neighborhoods on Oahu last year were all suburban or ex-urban, right? Top neighborhood, North Shore, followed by Hawaii Kai, Aina, East Honolulu, then Windward Oahu, then out in Mililani, Central, So, right, the hinterlands experience the highest rates of home price appreciation, whereas the urban core actually experienced depreciation, which is to say both single-family homes in Kaka'ako. Yeah, there's not a big market. So let's look at condos. Oops, you see the same thing. You see a pattern in which the appreciation last year, the COVID year, was concentrated in these ex-urban areas outside the urban core, whereas within the urban core, patterns of appreciation were actually negative in 2020. Now, that's amplified by the vacation rental fire sale that I alluded to earlier, right? The city, created the vacation rental Gestapo so you can narc on your neighbors, and so people were, trying to get rid of their vacation rental investments down in Waikiki. One of the factors at work here is the so-called remote work or work from home phenomenon. Now, people were working from home before COVID. I've been working from home since 2009. If you call it work, just kidding. But, for a lot of people, working at home beginning a year ago, back in March and April of 2020, was kind of a new phenomenon. And very quickly, both employees and employers, after a couple months, decided, hey, I kind of like this. So let me give you a feel for how big a change in the structure of the workforce COVID-related work from home has introduced. There is a permanent part to what at the time was thought would be a temporary change. And we're still working it out. So again, another one of these works in progress. But let me show you the data. Pre-COVID, before March 2020, basically, 90% of American workers had never worked from home. I'll say that again. Before COVID, 90% of US workers had never worked at home, and only 3.4% of US workers worked from home 5 days a week. That was the norm, right? When people talk about the new normal, the old normal was 90% of people work in a workplace, 10% are able to work at home, but of those 10 percentage points, only 3 or 4 percentage points work from home full-time or 5 days a week. Very quickly, this is a survey from May of last year, very quickly, firms realized that working from home might be something that they permanently would embrace. And the surveys in May of last year were suggesting that post-COVID, up to 25% or more of workers could continue to work from home after the pandemic ended. Well, we have more recent data. In a survey about 6 months ago, my professional association asked respondents, how many of your workers, there's a survey of firms in the panel, how many of your employees worked at home? And survey says more than a third of firms responded that all employees had worked from home because of the health crisis. Almost another third responded that most employees. So huge numbers, huge proportions of the workforce engaged in remote work last year. And as you know, huge numbers of children in school bought a laptop and were Zooming their classes. The data, so important was the shift in the pattern of where work was occurring that the U.S. Commerce Bureau of Labor Statistics actually began measuring it in ways it hadn't before. So this is an extraordinary data set that is now being published by the BLS. These are data through April of this year. So we go back to it's about a year's worth of data. And you can see the proportion of workers 25 and over who are working at home by educational attainment. So the average right now is about 20%. It had been 35 to 40% a year ago, but the average today, the total is that 20% of workers are working at home because of COVID-19, right? Where there's the 20% in addition to the 5 or 10% that worked from home, or at least some of the time when, pre-COVID. So 20% of the total working at home. But for persons with college degrees, the proportion is 30%. And for persons with advanced degrees, the proportion is 40%. So you have another texture in all of this. Yes, there's an increase in work from home, but it's particularly strong for for these workers, excuse me, with higher educational attainment. I'm going to cough, sorry. Zoom protocol, mute when you cough. Not so much for those with lower educational attainment. Of course, those with lower educational attainment, those who have to go back to a workplace or are increasingly returning to one, tend to have lower productivity and lower compensation, whereas those with higher educational attainment, higher skills, higher compensation, higher productivity, higher compensation. You can see how this pattern of remote work could contribute to the polarization of income and wealth and economic opportunity. Just another one of those things that's going on. People who work at home, sorry, a few more data sets here. People work at home, who worked at home and the firms that employed them discovered very quickly that things were working out way better than people thought. So in another one of these recent surveys conducted, this one is by Nick Bloom at Stanford, who's an economist who's been tracking this. By the way, I'll send a PDF copy of the slides to your regional group, to the board, Honolulu board, and you can get a PDF. Feel free to share it with your clients if they have an interest. You never know. There's nerds buy houses, don't they? And at the bottom of each slide are the links to all the data that I use here. And in addition to, helpful resources. So for example, I have not just, these are data from Nicholas Bloom from Stanford, but I have a link to the YouTube webinar. There's a webinar on YouTube, a Princeton webinar in which he was talking about this phenomenon, and also the working paper he wrote back in January, or at least that version of the working paper that describes some of these data. So by now you can see, when you ask firms, how did working from home work out, nearly 20% said that it was hugely better than expected. Another 20% said it was substantially better than expected. Another 20% said it was better than expected. And only a quarter of firms responded that things are about the same, and much smaller numbers responding that things didn't work out. Indeed, only about 7 plus 3 is 10 plus another 3, only about 10 or 15% of respondents thought that work from home turned out worse than expected. So these are really, really interesting results. And it's not just the way things turned out or the proportions of people who work from home. It's other consequences of this. So here's an example. This is the growth of investment in information technology, equipment, and software. And look at what happened during the COVID recession. During the COVID, IT equipment and software investment in America tended to grow between 5 to 10% per year in the late 2010s. It's a thing we use our devices and we upgrade them, and it's just, this is the world we live in. At the COVID moment a year ago, IT equipment and software investment exploded to 10 to 20% of growth quarterly at an annual rate. And this continued right through the first quarter of this year. So it's not just remote work. The COVID shift resulted in an explosion of demand for information technology, equipment, and software. And as you've probably been following in the popular media, this has resulted in some major dislocations in the supply chain for computer processors and chips and whatnot. Here's another thing. Who would have known? These are the numbers of applications for a federal employer identification number, right? A federal EIN. Pre-COVID, you can see the pattern: growth before the 2008 recession, a shallow subsidence of applications for EINs during the 2008-2009 recession, and then a stagnation in the early part of the 2010s before a more robust recovery around in the 2010s, 2013, 2014, culminating in an increase over a decade or more from about and I'm sorry, these are 200, these are thousands. I keep forgetting to change this slide. I'll try to remember to do it before I burn the PDF. But this is 200,000 applications per month. These are monthly data to 300,000 pre-COVID, and then suddenly an explosion. So think of the logic here. I'm working at home. I've got my new computer. My kids have their new computers. We just realized how awesome these new computers are. They're so much faster than our old computer. The bandwidth is so much faster. And all of a sudden I'm realizing, hey, I'm sitting here at home. I could start a business. Ba-boom. Or as we say in Hawaii, baboosh. There's that increase in entrepreneurship, which I keep thinking is gonna, like is a one-time thing. Hell no, that thing is, these are, I just downloaded these data yesterday. It's just exploded. This is through April of this year. So an ongoing explosion of business formation. Who would have thought in the wake of the COVID recession that plausibly is a phenomenon, if not perfectly correlated with, is nonetheless associated with what we see in the remote work data. How many firms, how many workers do firms think are going to return to the pre-pandemic arrangement? This is hard to interpret, but the numbers I'm getting now are something like 20 to 25% of workers, maybe 30%, but let's say a fifth to a quarter of workers in America probably will permanently work from home at least several days a week. So the most likely outcome that people are seeing now is something in which hybrid arrangements, I work for a few days a week at home, I work a few days a week at the office, hybrid arrangements plausibly could characterize, a quarter of employment in America. Now, we're seeing it in Hawaii. If you think about what's happening on Oahu, right? If I don't have to commute to downtown, if I don't have to commute into the urban core of Honolulu, well, I can go live on some ridge out in Hawaii Kai. I can go live up in Waialua. I can live in Windward Oahu. I never have to drive over the Pali. And that's what you see in those, certainly in those single family home data. It does suggest, however, a countervailing, right? There's always a pendulum swing going on. So in opposition to Nicholas Bloom's argument that remote work is here to stay, we have the argument of Ed Glazer at Harvard, the Stanford of the East Coast. Just kidding. Ed Glazer has been saying all along that, yeah, remote work came, but things are going to go back to normal or closer to normal than you might imagine, partly because collaboration is very challenging in this sort of Zoom universe. And what makes collaboration productive is proximity, right? It's what's called an agglomeration externality, the positive side effect of agglomeration, the unintended, uncompensated benefit of co-location. So there's a reason there's a downtown. It's the reason there's a downtown. It's the reason there's a campus. It's the reason there's a resort area. That agglomeration externalities, these positive external benefits, tend to balance against the negative congestion externalities, right? The cost of getting to downtown. And yes, some workers have been liberated from the need to go downtown, to the need to go to the urban core, to the metro region of the Honolulu Board of Realtors. But for others, they can't wait to go back. So as I say, these things are going to sort themselves out. Just so you know, in the broader regional perspective, what's happening in Honolulu, and let's just look at single-family home prices, which are about to hit $1 million. What's happening in Honolulu at the tail end of this 40 or 50-year, roller coaster ride around the escalation trajectory that we saw before in those detrended data. What's happening in Honolulu is happening in the rest of California. So remote work is not unique to Hawaii. It hasn't yet shown up in the Federal Housing Finance Agency data. These are broad data sets, including the mortgage valuations. So we're all kind of waiting to see that. And if you think about it for a second, it happened in single-family homes. It happened on the North Shore or East Honolulu or Windward Oahu, not so much for downtown. But it didn't happen in condos. And so if you say, well, what happened on average to housing valuations on Oahu? Well, on average, it didn't really happen. I mean, it happened in some parts of the market. But if you had to average over all the condos and single-family homes and all the neighborhoods on Oahu, on average, things are not nearly as bubblicious as they might appear to be in single-family homes. I'm just, the single-family home prices are going to get all the headlines. They'll put $1 million, that's going to be the headline. Be the headline above the fold, top of the Honolulu Advertiser. $1 million, right? Says Dr. Evil. But the reality is that things aren't quite as crazy as that. And in fact, when we look at the distribution of all home prices for Oahu, this is single-family and condominium prices, on an annual basis, and I've done selected years here to make, to give it some clarity. But you can see I've listed the years for which I've calculated from your board's data an empirical distribution function. Right? Most of us are peasants. We live in a relatively affordable house because we can't afford a high-priced house. But there's a few people out there in the 2 million to 20 million I did these data for Kauai. There's guys paying 30, 40 million for a house. Forget about those guys. I want to be those guys, but we don't care about those guys. Most people live, in a $500,000 to $1 million home on Oahu. And you see that in these distributions over time. If I take 2 years at the peak or near a peak of a prior housing bubble, I'll take 1992, which I've listed there, and I take 2007. If I remove those years from the data set, here's what it looks like. Let me go back. There's with the bubbles, without the bubbles, with the bubbles, without the bubbles, without, without the bubblicious years. If I take away the overshoot in median home prices associated with asset pricing bubbles in the past, the 2020 data set, which includes some of this bubbleiciousness in Oahu's outlying neighborhoods, primarily in single-family homes, if I remove prior overshoots, the transition from year to year in the distribution of home prices is relatively orderly. Like you see the pattern. And yes, eventually the median is going to be 1 million, right? What's the median? The median is the middle of this distribution, where half the area is on one side of the distribution and half the area under that curve is on the other side of the median. So yes, in this apparently orderly, or often, if not most of the time, even most of the time, if not all the time, orderly transition into which 2020 still kind of fits, its orderliness is the thing that stands out. The trend is what really stands out. And most housing, most home buyers, most housing investors are actually looking for the longer term returns. Yes, I get that, people speculate, and that's fine. There's nothing wrong with that. In fact, speculation is what helps us discover whether something is going on or not. They take on the risk that the rest of us are averse to. But I still think that we're not in a bubblicious situation. Affordability, because of low interest rates, was relatively good for the last couple of years. This was an historic moment. The last 2 years was an historic moment for housing affordability on Oahu. I don't know why everybody's talking about an affordability crisis. It was never more affordable. Let me say this again. Housing on Oahu was never more affordable than it was in 2019. in the middle of a affordability crisis. So I'm told. People keep telling me this. So there's an affordability crisis. So I don't know. Sorry, dude. You should have been here yesterday. Guess you missed it. Oops. I mean, interest rates are still low, but they're not going to be forever. And by the way, they're not going to go up that much. So yes, there's a certain bubbleliciousness that's crept into home prices. Maybe not so much for condos, although they're not, roadkill. I mean, condos continue to appreciate at more modest rates. I think a big factor right now is low interest rates help both condos and single family homes. So it's not the interest rate environment that's at work here. On the margins of what's happening out in the North Shore, Windward, Oahu, East Honolulu, other suburban or exurban areas, right? In Zoom towns across America, right? The work from home phenomenon, the fact that people can work remotely, no longer have to go to an office, is having an impact. It's probably a one-time shift. It's affecting other real estate segments. Commercial real estate's all kapakahi, right? If I don't have to go back to an office, why do I even have an office? Good luck if you own a building. Retail, seriously, are you still going to Macy's? Why? I don't go into Target. I drive through Target's parking lot. You did the drive-by pickup. I forgot to pick up my coffee last night, which is why I was scrambling to make some this morning. And of course, there's a debate between Nicholas Bloom, who thinks that work from home is here to stay, and Ed Glazer, who's saying, well, it's not over till, the fat millennial sings, by which he means if people have left Kaka'ako to go live in some, beach mansion in Pupukea, then doesn't that mean that the comparative affordability of condos in Kaka'ako, if they're not appreciating as rapidly as single-family homes, out in Hawaii Kai, it doesn't the comparative affordability of condos mean that as the boomers abandon some of these neighborhoods, the millennials are going to swarm into them? And you're seeing that now in, say, Midtown Manhattan. I heard this the other day. I hate telling anecdotes because they never generalize, but I heard this story, so it must be true. Somebody told me their daughter just rented an apartment in Soho in New York City for $1,700 a month. That doesn't sound like Manhattan. Anyway, I'm just saying, wait to see how this works out. Let me just finally do a little sort of conceptual stuff. I'm sorry, I couldn't resist the temptation to draw this picture. And by the way, I drew this picture. This is not a real data set. It's a fake one that I made up. Remember when we used to have classes and you'd go to the blackboard and you would draw, okay, that's me. So on the bottom, I have a trajectory. Here's the proportion of people that worked remotely pre-COVID, 5 or 10%. And here's the proportion of workers that will work remotely post-COVID, 20 to 25%. So there's a one-time increase, a permanent increase in the proportion of workers working remotely from 5 to 10% to 20 to 25%, something in that neighborhood. That is, there is a permanent increase in the stock of workers utilizing their homes, not just for habitation, but also for production. What does that imply for single family, let's say, because it's not showing up in condos, what does that imply for single family housing demand? The permanent increase in the stock of workers working remotely results in a transitory increase in the flow demand for single family home. There's an increase in demand while you make the adjustment. And once you've reoptimized, once you've got the house you actually need now, given the way you do your work, right? Before, you had a house that was closer to downtown to reduce the length of your commute. But now you don't commute. So you can go live off on the ends of the earth, as I say, in Zoom towns across rural America. That one-time increase in the proportion of workers working remotely results in a temporary surge in demand. But once the adjustment is over, demand goes back to growing at the rate it was growing previously. So the demand effect, I hypothesize, is transitory. What about the supply side? The demand side changed temporarily. What about the supply side? And for housing on Oahu, are you kidding me? What supply? I mean, what? How long did it take Castle and Cook to get entitlement to build Koa Ridge? About 20 years. It took 20 years to get permission to build on land at an H2 freeway off-ramp across the street from Costco. Okay, so the supply response, and that's why the prices are jumping. Demand changes quickly, but supply cannot change because we created this apparatus to ensure that there's not enough housing supply. That's the crisis. There's not an affordability crisis. There's a supply crisis. We can't build houses fast enough. They won't let us. And there we are talking about the same thing we've been talking about for I don't know how long, and we're all bored of it. So I'll stop there and